All right. Well, thank you guys. Our next presenting company is Tenaz Energy. Its ticker symbol is TNZ on the Toronto Stock Exchange. Tony Marino is the CEO. Tenaz Energy is a publicly traded company focused on the acquisition and sustainable development of international oil and gas assets capable of returning free cash flow to shareholders. Tenaz has domestic operations in Canada along with offshore gas assets in the Netherlands. The domestic operation consists of semi-conventional oil production in the Rex, member of the Upper Manville Group in central Alberta. The Netherlands gas assets are located in the Dutch sector of the North Sea. Tenaz also has an ownership interest in the, and I don't even know, that's, is it the British Virgin Islands or BV?
No, it would be NGT in Netherlands pipeline. And,
okay.
Yeah.
Okay, and I'm sure he'll tell you all about it. I appreciate it. And so with no further ado, Tony Marino, thank you.
Thank you very much. Thanks to everybody for attending. It's good to be back at EnerCom. So first, we'd ask that you note our advisory on forward-looking statements. We'll go through some background on the company. So we are a public E&P. We're TNZ on the TSX. Today I'll speak first to our current asset base, our Canadian oil growth project in Alberta and our Dutch natural gas project offshore. Really what's most important for us is what we do going forward with our international acquire and exploit strategy, so I'll spend a bit of time talking about that later. The company is debt-free. In fact, we have negative net debt of 64 million Canadian, and I'll point out that in this presentation all the monetary values that are listed here are in Canadian dollars unless we otherwise note that they're USD or Euro. The company, we feel, does have access to the capital markets, as demonstrated in the recap and in the previous history of the team. And we do think that management has a record of effectively being able to create value using the same strategy of international M&A and then subsequent operational improvement. So what the company is going to be doing going forward is to source potential acquisitions, do a very careful technical evaluation of them with the objective of taking the controllable risk out of the acquisitions, focusing primarily on Europe and Middle East, North Africa, although we have a tertiary interest as well in the Americas. Upon making these transactions, we'd seek to apply our operating and technical capabilities to improve the production and cost performance. I'll talk more about that later as well. And ultimately, we want to build a portfolio of assets, a diversified set of assets that are capable of supporting a growth and income model in the public markets. Briefly on the management, the team has been together for a lot of the elements of the team actually for almost a 20-year period. 5 of the 6 officers that you'll see come from Vermilion Energy, and previously a number of us worked at Baytex and Dominion prior to that. Previously, I ran Vermilion, and before that, ran Baytex Energy. Mike Kaluza, our COO, was the Chief Operating Officer also at Vermilion, running a 100,000 BOED operation in 9 countries. Brad Bedant, our CFO, was Treasurer and Manager of Financial Reporting at Vermilion. On the bottom row here, we list 3 other officers. The one of the 6 officers on this list who did not come from Vermilion was Jen Russell Houston, a very highly qualified geologist who is our geoscience VP. She was with OSIM and led the growth there. Ultimately, that company sold to Waterous. John Balkwill, who's with us in the audience today, is our VP of Corporate Development, and he had asset management and BD roles at Vermilion. David Burkhart, our SVP of Engineering, was the CEO of the company that we recapped, Altura Energy, the company we recapped to become Tenaz. Previous to that, he was the MD for the French unit of Vermilion. So again, a team that's worked together a lot, and we're very motivated to pursue this common goal to create value through international acquire and exploit strategy. Briefly on the board, Marty Proctor is our chair. Marty was the CEO of Seven Gens, very successful and large Canadian gas company bought by ARC. Previously had a lot of experience in the U.S. and overseas. Anna Alderson is our audit chair. She was an audit partner with KPMG in energy and financial services. John Chambers is a continuing director who came from Altura. He was one of the founders of First Energy, very successful independent dealer in Calgary. And Mark Rollins is an international director. He was basically co-COO of British Gas during its growth heyday, and he also was CEO of the second largest Ukrainian E&P, Ukranafta. The board is qualified in all the areas that are going to be important to the long-term success of the company: background in operations, background in the capital markets, and very focused on ESG. Management of the company as well has a great deal of experience in ESG and sustainability, and we're going to use it to the advantage of the company going forward. So the history of Tenaz is that we began as a public company by recapitalizing Altura Energy. So Altura Energy was a TSXV company. We effected that recap in October 21. Management and institutional and some retail investors putting money in the company to effect the recap and change the strategy of Altura to emphasize international acquisition. On the bottom left panel, we point out here that since the recap, we've been able to triple production up to a guidance level of 2,300 to 2,500 BOED for this year, counting our most recent Netherlands acquisition only at mid-year in terms of its production contribution. On the lower right panel, we point out that cash flow, or FFO, will be up about tenfold since the recap, really driven by this increase in production, but also by bringing in a very high netback product, TTF natural gas, into the product mix for Tenaz with its high netbacks. On the upper right, we point out the financial position of the company. Altura had a small amount of debt in place. We paid that off with the recap, and subsequently we've added to our cash balance in the company. We brought in about 47 million Canadian in our most recent transaction that we made with XTO in Netherlands, or a subsidiary of ExxonMobil, bringing that cash onto the balance sheet via that transaction without any equity or debt issuance. And now our negative net debt level, or our positive working capital, is 64 million Canadian. At the same time that the production's gone up, the cash flow's gone up, and the cash balance in the company has gone up, we've retired about 4% of the shares through an NCIB. This slide shows the market performance of the company, traded as TNZ on the TSX during 2023. There are, I think, 55 E&Ps that trade on the TSX, ranging from the very smallest company all the way up to the largest, probably CNQ. And in that list of 55, I believe we are now second in TSR for 2023. One of the smaller companies is still ahead of us. With that stock price change, we have about a $100 million market cap. There's two columns reported here to take it to EV. At the end of Q2, we had 17 million of net working capital, or negative net debt, on the balance sheet. Right after the end of the second quarter, in the early part of July, we closed that second Netherlands transaction, buying XTO Netherlands from ExxonMobil, brought in the additional cash, positive net working capital, onto the balance sheet. That number now is standing at 64 million, giving us a pro forma EV at roughly today's trading price of about $38 million. So that EV compares to a 2P NAV discounted at 10% per McDaniel's independent evaluation for the combination of assets, Canada and the two pieces that we bought in Netherlands, totaling up to about 110 million. On top of that, we recently released our contingent resource report, again evaluated independently by McDaniel, That indicates contingently were 4 fields in the Netherlands that have been discovered to be developed would add a value of $86 million on a NPV 10 basis. So those numbers of 110 and 86 comparing to this EV of 38 million currently in the market. On the bottom of the slide, we point out that the management and the directors of Tenaz are highly incentivized and highly aligned to perform for the shareholders. On a basic basis, through the investment primarily in the recap, we hold 9% of the basic shares, and on a fully diluted basis, 22% of the shares of the company. And certainly we think that this is right to be in the same boat as the shareholders, and we do intend to deliver for the entire shareholder group. And just very briefly on the 23 outlook, production guidance 2,300 to 2,500 BOED. That counts XTO only at mid-year after closing. CapEx, Canadian dollar 20 to 24 million. We didn't add any CapEx with the XTO deal, having been running a little bit below the guidance level previously, and we'll be drilling 4 gross 3.35 net wells in Canada this year. Product mix in the pie chart, about 39% out of Canadian oil, another 38% from Netherlands gas, TTF marker, very high priced. I'll talk about that later. Very good contributor to netback cash flow and free cash flow. And then another 24% from AECO. Definitely a lower valued product, one that we have hedged primarily through physical contracts at levels above today's price. So now briefly I'd like to run through both sets of assets, Canada first and then Netherlands, keeping in mind that what is really important is what we put in place through this international acquire and exploit strategy for the long term, and I'll talk about that a little bit at the end of the presentation. So the asset in Canada is a semi-conventional oil development project south of Edmonton, Alberta. This is the project that Altura had at the time that we made the recap. And it's a great find by Altura. It's a shallow field, 1,300 meters deep. It's in the Manville Formation, Rex member, a sandstone, moderately low permeability, I would say kind of in the single digits, millidarcies. Altura, even though this zone had been drilled through many times on the way to the deeper horizons at Leduc, Altura recognized that it had potential for development with horizontal wells and multi-stage fracs, and they found actually what is quite a large field. I think if you include the entire mapping of the field, it can be up to 500 million barrels in place. We probably control on the order of 350 or 400 million barrels of OIP, probably just about everything that is developable in the field. We felt it was a very good project that Altura had found, and it was one of the attractions behind using that as the recap. I mean, the bigger purpose in the recap, of course, was to get the public vehicle for which to finance and have valued future acquisitions, but this is certainly a good asset. Now, in and of itself, the asset, I would say, is not large enough to carry a mid-cap company, and it starts at a pretty low level of production that we're now increasing, but it is high rate of return. It's certainly worthwhile to have in the portfolio and to invest in. We have 7/8 of the project really in full operating control, booked at year-end 22 at 12.5 million barrels equivalent, which is only a few percent recovery factor within that area. The 2P report has 40 gross locations. Current drilling pace, that would be 10 years of inventory, and probably more that could be developed outside of the currently recognized locations. It does have a lot of infrastructure to accommodate growth, some localized expansions required, but in general, most everything we would need for probably a 2 to 3x increase in production. This year's guidance midpoint is 1,500 BOED. We increased production 20% last year, and this year's number would represent about another 25% increase. Those increases being achieved on a 4 gross, 3.35 net well program, requiring a midpoint of 17 million Canadian in CapEx. On the way up, this asset can produce free cash, and it's certainly going to produce a lot when we get to the plateau level in a few years. Briefly, I'll describe the characteristics of the wells and what Tenaz has done with them and the economic performance. Altura began developing the field with 1.25 mile long wells. We're now up to about 2.25 mile long wells, and of course we do believe that this gives us better capital efficiency to get the longer laterals. We've made some other changes, tighter frac spacing, higher conductivity, scour, better geologic description to get the laterals completely within the zone and achieving very nearly 100% frac placement. And I point out these things because when I talk about the international strategy, one key point about it is that, yes, while we get assets at lower multiples and higher rates of return on the base purchase overseas, it's very important as well what we can do with the assets after we have them, especially in an operating position. And we feel that overseas there's a much greater opportunity for operating improvement than you find in the domestic assets. Altura made a great find. They're an efficient producer, but Tenaz was able to come in here and significantly improve the design and performance of the wells, and that's what we seek to do overseas, and I think in a place that has much more opportunity to make that kind of improvement as compared to North America. These 2.25 mile long wells, as you can see on the production plot, generate 250 to 300 BOED at the peak. At 4.35 million Canadian per well DSET CapEx, that generates around a 20,000 per day barrel capital efficiency. It's about an $11 F&D. We had a 2.9x organic recycle at the last reserve report. So it's very efficient in terms of capital, high rate of return on an ATAX basis, and a payout a little bit over 1 year. So good economics, and an example of the type of thing that we would do with operating, we would intend to do with operating control in overseas assets as well. And also in this semi-conventional development, which we think of as using horizontal wells in a clastic, in a low perm clastic, but not in an ultra-tight rock, it's also something that we see as having upside in a lot of the international basins that don't have this kind of horizontal development, although it's very common in North America. So that is the Canadian project. Again, not the main reason for the company, but a good piece of the portfolio. Next, I'll turn to the European assets, offshore Netherlands. We've made 2 transactions over the past 7 months to create this non-op position in this very high-margin TTF gas. These are all in the shallow water close to shore. They're in the Rotliegend sandstone, conventional, moderate permeability rock, very predictable. The reserve totals, if you put the 2 deals together, roughly 2 million barrels equivalent, and a run rate of about 1,250 BOED at the end of the second quarter. Certainly a real positive defining characteristic of this region is this TTF index gas. Very high priced. The balance of the year on the strip is 14 US per M. Next year's strip is about 17 US per M. It's a volatile product, but probably one that's going to have good pricing for some time. There's still risks in the sources that have been used to replace the historic Russian gas. There's still Russian supply into Europe that I think is not guaranteed to continue. So probably will be a high value product, and it's certainly one that contributes a lot of net back and free cash for Tenaz. In addition to the upstream, I'll discuss it later, we have a significant interest in a midstream gathering system that gathers this gas and gas for other operators in the area. And there is an option on a potential CCS project as well in some of the depleted fields. Having acquired just XTO for accounting purposes at mid-year, guidance is 850 to 950 BOED for this set of assets with low CapEx, 4 to 6 million Canadian for the year. The next 2 slides address the undeveloped upstream potential. I'll just spend a second on this one. There's a number of, there's 4 actually, discovered, tested, undeveloped fields. 2 of them are oil fields in the northern part of our asset block that are operated by Wintershall, the Vermeer and Rembrandt oil discoveries. The estimated production from these, if and when developed, would be 20,000 oil a day out of the chalk. And we have a 5% interest there, so that would be 1,000 net to Tenaz, pretty significant compared to the existing production for the company. And there are 2 undeveloped gas fields that have been discovered in the Neptune-operated acreage in the southern end that have economic promise as well. We haven't attributed any reserves to these fields. We did contract for a contingent report by McDaniel, contingent and prospective report to cover all the undeveloped asset base. These 4 fields that I talked about, 2 oil, 2 gas, went into contingent resource. The mean estimate for recoverable reserves net to our interest is 4.5 million BOE, again, combination of oil and gas. Again, that compares to about 14.5 million barrels equivalent for the company 2P reserves today. And we had an economic case created for the best estimate or the midpoint on these 4 fields with a value of 86 million NPV 10 A-tax. So again, pretty significant in comparison to our company EV. In addition, there are 21 exploration prospects classified as prospective resource, not fields that haven't been drilled, fields that haven't been discovered. Majority of these are gas, and the mean estimate on a risked basis, if drilled, would be another 10 million barrels equivalent. So we feel a lot of undeveloped potential in the upstream that we acquired. In the midstream, we have a 21% interest in the NGT pipeline, offshore pipeline system and onshore processing facilities. This system is a very high reliability set of assets. It's had 99.83% uptime since '91. It covers about a third of the Dutch offshore, serving the northern area. There's a number of undeveloped fields in here, not only ours, but other operators that can contribute to this system for the longer term. It has a role in the energy transition for Netherlands, being certified to transport green hydrogen from the kind of the very far distal wind fields that are expected to be developed. And in the meantime, it has a pretty significant dividend stream, 27 million Canadian a year to all the shareholders. We have 21% of that, 5.5 or $6 million a year of dividends that have been applied at a very consistent basis. So a very desirable asset for us to have, serving our assets and those of other operators. There is an option value on CCS. These fields and some depleted gas fields that already exist are situated very favorably compared to some of the major emitters in the Netherlands and in Belgium. And the operator of the gas fields, Neptune Energy, is currently evaluating the potential for a CCS project. It's thought that the main stores here could be as high as 120 or 150 megatons of CO2 and injecting at a rate of probably around 5 megatons per year. There is a high carbon price in Europe, 85 euros a ton. There are incentives for emitters to commit to this kind of project. If the project proceeds and if we participate in it, we would have an 11.35% interest. That would be enough carbon offset to cover Tenaz up to a production level of about 50,000 BOED, or roughly 20 times our current level, while maintaining carbon neutrality. Again, there's no certainty that it will have an investment here, but it is another potential source of value out of the Netherlands assets. So with that discussion of the existing assets, I want to spend just a couple of minutes to discuss the overall strategy for international acquisitions. The first thing on this slide to note is the map. So we colored in all the jurisdictions, both in dark blue and light blue, where the team has experience. And we've shaded in the dark blue the jurisdictions that we think, at least initially, are worthy of consideration for investment. Our main geographic area of emphasis is Europe. The second most important to us is MENA, or Middle East, North Africa. And then we have a tertiary interest in Americas, including potentially optionality for Canada. no intention at this point of attempting to compete in the U.S., although the team does have experience there previously. We know it's a wide funnel. We think that's a good thing, allows us to select the best projects in attempting to find deals and find value for the shareholders. We are open to and experienced both in oil and gas, open to and experienced both in onshore and offshore. The main project type that we would seek is conventional assets, primary oil, primary gas, waterflood, potentially EOR. There's a lot of big fields in these regions that are owned by large companies that are later in life, not the main expertise set or the most area that these bigger companies are competitive in. Typically, a lot of projects have been identified but not invested in over the last few years, and we think that's a great opportunity for us. Also, as I mentioned earlier, we see in a number of these strat columns in these areas the potential for these semi-conventional projects where we have low-perm conventional clastic traps that might benefit from horizontal development, but it's mainly the conventional production. The advantage overseas leading to these higher returns is really twofold. First of all, it's less competitive than it is in North America. A typical transaction in North America might have 5 bidders or even up to 10 bidders on it, whereas in these overseas markets, there just aren't that many competing teams that have the financing capability, the operational expertise, the ESG credentials to gain the support of the sellers and of the host governments. So typically what we end up going against, and they're generally not competitive bid situations, but could be no other companies competing with us, it could be 1 or 2. When you get down to that low level of competition, I think you can see how you can get to higher base rates of return, lower multiples and higher base level rates of return. And then on top of that, there is this operating advantage that we talked about earlier. There's just no question, and we've seen this in our experience, that there are more folds of improvement that are available in terms of production and costs in these overseas assets than in North America. The North American industry is super efficient and super competitive. You can make improvements when you acquire, but not nearly to the degree that you can internationally. So that if you combine those low multiples, high rates of return in the base purchase with a better opportunity for improvement, you can make very high returns on capital when acquiring overseas, and that's what we seek to do. Final point on the slide is, as I mentioned, the board and the management of the team, the management team has a great deal of experience in sustainability projects, using those to get access, acceptance in the host jurisdictions, and in a way that benefits the broad stakeholder group, but also our shareholders. And we will be using that here. Just to spend maybe 1 minute on the business philosophy upon acquisition. Culturally, we will have a flat company, everybody in the company incentivized with equity, a very technically focused company, a very practical company. In terms of the operating structure, decentralized. We typically acquire a very competent national workforce. Usually they've generated a lot of projects that have not been invested in. We put in a little bit of North American content in management and technical resources, and typically we get quite an improvement in the performance of the assets. Capital markets will use low financial leverage. We will control the operating leverage with a degree of hedging and use this set of assets in a growth and income model for the shareholder group. We have a buyback today. We don't have a dividend at our small size, but we do intend to return capital to shareholders over the long term. Just to summarize, we think there's deep value in this market for the reasons I talked about. The low multiples at the beginning, the operating improvement that's available. We'll be stressing Europe, MENA, and then the Americas. The management of the company does have experience in this model, $6 billion in acquisitions historically, and we have successfully executed each part of the strategy. Thirdly, we're aligned with the shareholders, and we have used this kind of business model effectively in a growth and income capital markets model previously. So thank you for your attention, and look forward to the breakout.